All right, good afternoon and welcome back to Chartered Mind tutorial. Let us look at this question. We analyze it and then find out what type of lease arrangement is this. We can give our suggested solution to the question. Now the background. Solaris Manufacturing Limited sold its production facility to Nexus Capital Limited on 1st January 2024 under a sale and leaseback arrangement. The sale price was set above the building's fair value. Carrying amount at transaction details. Carrying amount at 1st January 2024, 6 million. Fair value at 1st January 2024, 10 million. Sale price, 11.5 million. Lease back term, 5 years. Annual lease payments payable in arrears, 600,000. Incremental borrowing rate, 5% per annum. The transfer qualifies as a sale under IFRS 15. Solaris has for 31st December year-end requirements. Identify and explain the off-market element and state how IFRS 16 requires it to be treated. Calculate the adjusted lease liability and right of use of assets. Calculate the gain to be recognized in profit or loss. Prepare opening journal entry on 1st January 2024. Prepare lease liability amortization schedule and additional financial liability schedule for all 5 years. All right, so this is the question. Let us summarize it on our worksheet. The company name is Solaris Limited. Solaris Limited. Okay. Accounting year began from when? From 1st January 2024 and ended in on what? 31st December 2024. So you have what? Your carrying amount, fair value of what? Of the asset, sale of what? Of sale price, annual lease payment, borrowing cost, term of the arrangement. So here we have our carrying amount to be 6 million. We have our 6 million. We have our fair value to be 10 million. We also have our how much the asset was sold 11.5 million. Lease payment, annual lease payment is 600,000. Borrowing cost is how 5% per annum, and then term is what? Is 5 years. So this is the what? This is the summary of what they want us to do. Okay, so let us look at this question. It's what type of lease arrangement is this? So when we go back into the question, they said the arrangement is sale and leaseback arrangement. Okay, so we recognize that the arrangement is what? Sale and a leaseback. That's the arrangement. Now, under sale and leaseback, what type of sale and leaseback is this? In order to know that one, let us know the fair value of of this asset that is. So the fair value of the asset is 10 million. And they sold this asset at how much? At 11.5 million. Under the sale and leaseback arrangement, the carrying amount of the assets, was what? Was 6 million. And they said that the fair value of the asset, which should be the market value. So if the current amount is 6 million and the market value is now 10 million, it means this is how much the asset should be sold in the market. But under this arrangement, the asset was sold more than the market price, which is 11.5 million. So when this happens, we call it what? Off-market sale and a leaseback. That is what it means. So when that happens, it means we sell it off the market price, outside the market price. So in this arrangement, the lease arrangement is what? Is off-market sale and and lease back. Into bracket, sale above fair value or market price. When you are confronted with a situation like this, how do we account for sale and lease back, which is off the market? So we have our solution. First, identify if the arrangement complies with IFRS 15. It means find out whether there's a sale. And when there is a sale, then there should be what? There should be what? There should be a transfer of what? Of the asset to the buyer. The buyer has what? Full control of the asset. So when these elements are present, it means the asset is what? Sold. So now we can now move to what? 2.2. Now, because this is what? The sale is above the market price, the next step is what? Is to find out what? The excess proceeds. So the excess proceed is what? You have your what? The sale price minus what? Minus the fair value. So yeah, you have your sale price what? 11.5 million minus fair value, which is 10,000. So the excess is what? 1,500. Good. This excess is what we call financial liability. This financial liability, what is the explanation to it? The explanation here is that the buyer, the simple explanation to this one, the buyer has what? Has paid more than how much he's supposed to pay. So if the buyer has paid more than how much he's supposed to pay, the excess, which is called what? Financial liability, will be paid back by what? By the lessee. The lessee will pay back, right? The one who bought the asset will what? Will receive the what? The difference back. That is the idea. That is the meaning of that. So the idea is here. The idea is that the what? The buyer agrees to buy the asset or the building above what? Above market value, which makes the what? The excess of what? Of the sale amount what? A financial, the sale amount what? A financial what? Liability. However, this excess payment shall be paid back by the seller. The seller is now the what? The lessee. Through what? Through the annual lease payment. So this is the idea. So at the end of the day, the excess money that the seller receive, he will surely pay back. So this has become, or this becomes a form of what? A loan to the what? To the seller. So that is the idea. All right. Now that we've understood this, let's come here. You do what you call adjustment of what? Of lease liability. Adjust lease liability. Now, how do you adjust lease liability? We adjust lease liability by what? By identifying the what? We say that identify the market portion of what? Of the annual lease. Good. What does this mean? What does this mean? This means that, have you seen the financial liability? This financial liability, so this is a financial liability. This financial liability must what? Must be paid back, which is 1,500. It must be paid back. So how are you going to receive it back? How is the what? Is the lessor going to receive this excess money paid back? He will receive it through what? Amortization. So this how you divide by the number of, or the terms of what? Of the lease. The term of the lease is what? 5 years. So when you divide it, you will get what? 300. So this 300 will be paid annually to the what? To the one who bought the asset. This money is what? Expected to be what? To be paid back to the what? To the buyer. So this is annual payment. It's supposed to what? It will be paid back to the what? To the buyer annually. So now that we know that we are going to pay this money back annually, what next? We know our annual lease. So now we are coming to do the adjustment. We know our annual lease. Annual lease to what? To be 600,000, right? Okay, so the lessee will have to pay this money to what? To the lessor annually. And remember, the one who is now the lessee is the one who sold the assets to the buyer. So now the lessee is now one who sold the asset to the buyer. So when he sold the asset to the buyer, there's an excess of 1,500, 1.5 million. So this 1.5 million has to be paid back. So when they are paying the excess back, they are not going to pay it in full. They will pay it in what? Annually. So they will pay it according to how the annual lease is going to be paid. Now, this is the annual lease that the lessee now going to pay back to the buyer, who is now the lessor. Okay. Now, this money was agreed. You understand? So this is the lessor who agreed that the lessee should pay this 600 every year. So if he agreed for the lessee to pay this money every year, it means that this money includes what the financial liability payment. That is the idea. That means that the annual lease 600 is what? Annual lease 600 include the financial liability. So you need to what? You need to split. So right, you need to what? You need to split. So how do you do the splitting? All you have to do is that your annual lease. Annual lease is what? Is 600. Then you less the financial liability that he will be paying annually, which is also 300. So when you less it, what do you have here? You will have what? 300. So after the split, you will have your annual lease payment to what? To be 300. Then you also have your financial liability that you'll be paying also every year 300. Good. So this is what that means. Now that we are done with with the splitting, what next? So we move to what? Point number 4. You have 4. So the 4 is what? What do you find? You need to find the lease liability. Now the lease liability, we know the process. You file your annual lease payment, which is how much now? 300. Then you will find annuity factor, which is 1 minus in bracket 1 plus rate to the power of rate, or to the power of n. So you have 1 minus into bracket 1 plus. They've given us rate. Rate is what? 0.05 to the power number of years is 5 years, all divided by the rate, which is 0.5 here. Okay, we have 300. So what do we have here? That gives me 4.33. So when I multiply, it gives me 1299. So now that this one is also clear, we now find our right of use of assets. Our right of use of asset under sale and leaseback follows a certain formula. So the formula for determining the right of use of assets is you have to know your carrying amount. You will multiply by by the lease liability. Then you divide it by by the fair value of the of the assets. Now we know our carrying amount to be 6 million, which is 6,000, multiplied by by the lease liability we just calculated, which is 1299, and fair value of the assets was 10,000. What do we have? So we have our our lease liability 779.4. So this one is 0.5. Now let's move to our 0.6. Now let us look for whether there's a gain on assets, gain on sale of of assets. Leasing sold the assets. Did he lose or did he gain? So that one too follows a process. So first find the full gain. So the full gain is is your fair value of of the asset minus the carrying amount of the asset. All right, so here in this instance, the fair value is how much? The fair value is 10,000 and the carrying amount is 6,000. So here the gain is 4,000. The standard says that this 4,000 cannot be reported by by the seller outright, because the seller has leased back back the asset, which means part of the asset will form part of right of use of asset to be amortized over the period, and then the rest of the balance or remain amount will be reported by by the seller in the book, because he decided to lease back the asset. All right, so in order to find that, how do we find the portion, gain portion? Now the gain portion also follows a formula. You will have the full gain is equal to what? The fair value less what? Lease liability, all divided by what? Fair value. You have it, the 4,000. This one should go multiplied. So you have this multiplied by what? The fair value, which is what? 10,000. And then the lease liability is 1299, all divided by what? The fair value, which is what? 10,000. So the portion that can be what? Can be recognized is how much? The portion that can be recognized is what? 348. Good. We are done with what? With the steps to this point. We are done with the steps up to this point. So now that we've had all that we need, then we can now start extracting our journal entries and other relevant extracts. So you have first, you start with what? Your journal entry. You have your debit, you have your credit. You sold the asset as a lessee. You earlier sold the asset. When you sold the asset, it is what? It is cash or bank that comes to you. How much did you sell that? You sold the asset as what? 11.5 million. And the asset that you sold is what? It's a building. The carrying amount of the asset is how much? You have to what? De-recognize this asset from your book because you've sold it. How much or what is the value of the asset that you sold? The carrying amount is what? Is 600. You credit it because assets have debit balance. So when you sold it, you have to credit it to remove it from the books. Okay. Now, after you sold this asset and you recognize this asset from your book, you also lease the asset back. So that is where you have our right of use of assets. So how much did we lease back? Let's go there and find our lease right of use of which is 7794. And it has debit balance. Asset is a non-current asset, so it has debit balance. So we have to bring it out at the debit side. After that, since we have right of use of assets being debit, then we will also have our lease liability. Right? Because once you know your lease liability, you know your right of use of asset as well. So you debit right of use of asset, then you credit the lease liability because you are going to pay for the asset over time. So it becomes liability in your book. How much is our lease liability? Let's go in. It's what? 1299. And because it's a liability, it's at the credit side. After that, remember, you have what? A liability to also settle, which is what? Financial liability. The financial the excess money that you took from the buyer, which is what? 1,500. So these are the entry that you must make. Okay, so let us see the balance. At the debit side, you have 1279.4. At the credit side, what do we have? The building is what? 6,000. 6,000 plus 1299 plus 1,500. At the credit side, you have 8,799. Now the difference between them is how much? The difference is what is at the credit side, which is what? 3,480. So this is where your gain on sale comes in. So the difference is your gain on sale. So when you look at it, you realize that the difference on gain on sale is the same as what we've calculated here. So if you are mindful and you can decide not to even use this formula to determine gain on sale, you can use what? You can use the journal entry to determine sale, your gain on sale. That is it about the journal entry. So let's move to our next. So this becomes our 0.7. So now we can move to other extracts. So 8. We can now do our amortization table or schedule. Okay, so here you have your years. So you have 2024, 2025, 2026, 2027, and 2028. All right, so here you have our opening balance. You have your they say the payment is in arrears. If the payment is in arrears, then the interest will come, and the interest is 5%. Good. Then our next item is is our lease payment. Then our last point is what? Our balance carry down here. Right. So our opening balance is how much? We have for lease liability with 1299. Then we charge interest of what? 5%. That gives you what? 64.95. How much are we paying annual lease? We are paying 600 every year. Under this one, we are paying 300, right? Not 600, 300, because we've deducted the financial liability. So our lease liability is 300. Okay. So we have what? 10, 6, 3.95. So your closing becomes your opening here. All right. All right. Then we charge your what? Your percentage. That gives you what? 53.1 or 53.20. So this gives me 807.15. So this becomes the opening and the so which is 817.15. Okay. Which is 40.86. That is 55.0. Okay. So that becomes what? Opening balance here, which is 558.0. So here we can what? 27.9. So here gives me 28528.9. So 285.9. So interest is how much? 14.3 plus 285.9. And that was 300. So here we give me 0. All right. So that is our amortization table. We are done with amortization. We are done with amortization table then. So 8, financial liability schedule. Money that they are going to also pay. They will pay this money. They will pay this money yearly, as well as their interest that they are, as well as their lease that they are paying every year. This liability has to be paid back. Okay. So you have what? Your balance. You have your what? Your balance. You have your balance. Then you will have your what? The extra money that you are paying. We call it what? Premium. And whatever you get is what? Whatever the balance that you have is what? Is your balance at end. Okay. So you have 2024, 2025. Okay. So you have this. So your balance per the person is what? 1,500, and you pay the premium. Your premium first payment is what? 300. So whatever you get is what is your balance at end, which is what? 1,200. Year 2, you have what? 1,200, and you pay 300. So whatever you get is what? 900. Year 3, you have what? 900. You pay 300, and then you have what? So the money is paid out off. So you have what? 300 here. So 300 here. You have nothing. So when you are done there, you can now do your what? Your extracts. Let's look at our profit and loss extracts. You have 2024, 2025. All right. So you'll start with our interest. Our interest for 2024 is 64. Then we can what? We can also bring the gains that what we made on what? On sale. How much was the gain on sale? The gain was what? 34.80. All right, so we can now calculate for our depreciation. Our depreciation right of use of assets what? 779.4, all divided by 5 years. What do we have? Divided by 5, that gives you 155.9. 155.9. So all of them are what? Apart from what? Apart from the gain on sale. All right. So so let's do our what? Profit. Our statement of what? Financial position. With regards to this one we will do only 2 years. We have for 2024 and what? 2025. All right. So you have it here. Non-current asset. So you have what? Right of use of asset. How much? So we know our asset got to be 779.4 minus depreciation of what? 1559. So here we are 6 to 3.5. That's 155.9. So here give me 467.6. Okay. All right. So we are done with this. Then we have to come to what your liabilities. So you have what your non-current asset. You have your non-current what liabilities. All right. So you have your non-current obligations. How much do you have here? You have for your lease obligation. You come with what? Then that's what you have for your financial liability. All right. Then you come to what? Your current. So you have your lease obligation, and you also have what your financial. So here your long-term obligation. All right, so let's look at the long-term liability. Now, when you look at the long-term liability, you realize that we have what the balances. So the balances will have to come to what to the long-term liability. However, this should have been the long-term liability of the company. We cannot what we cannot bring all these liability as a long-term liability unless we split between this amount and then what. So that will go what short-term liability and what and long-term liability, right? So the reason why at most they advise that you should pick the second one as what your long-term is because there's a split of what long-term and short-term. So when you pick 10,063.95 as your long-term liability, it means that you didn't split the short-term liability from it. The reason why they have come and pick 817 points as your long-term liability, then we deduct the short-term liability from 1063, right? So you see that there will be a split. So when you add the two, it should give you what 1063. So that's why you come here. The long-term liability here is what 817.15. Then the next one, which is 558, will also follow suit. So let's go to the short-term liability. When we go to the short-term liability, there's a difference between the two, the first one and the second one. So you'll have what thousand. You'll have it this way: 1,063.95 minus how much? Minus 8,063.95 minus 817.15. Now the difference will give you what the short-term liability. Then you pick the next one what will be 817.15 minus 558. Okay, so what do you have? 1,063.95 minus 817.15. So year one will what? Will be 246.8, and then 17.15 plus 558. So that also gives me 259.15. All right. So remember also the lease. Remember also, so this one comes here. So this is 817.15. Yeah. All right, good. So remember also the financial liability. The total financial liability to be serviced was how much? It was 1,500 all divided by what 5 years. That gives you how much? That gives you 300. So 300 you divide, you share, you when you look at the table the same. So you will have to what? You will have to remember. You will have to what? First 1 year of what will be paid. So the balance will be the long term here, which is 1,200, which will be the 1,200 here, and then the current will what will be 300, right? Then the following year it will be what? Here will be what 1,000 how much? Here will be 900. Here will also be 300. So this is how you prepare your extract based on the what information provided. That is it. Thank you very much.